Welcome everyone to a new video. In today's video we expand on last week's video where we saw yields rise extremely. Indeed, the rising yields does not go without consequence for the economy, and that is what we saw happen last week. Now, at a time when it is quite easy for the media to say that crypto is very dangerous, traditional finance is in a similar situation. If you can appreciate this extensive content, please leave a like on this video and don't forget to subscribe to this channel beneath. In addition to these videos, I'm also going live during the week on Monday and Thursday evening at 7 p.m. Central European Time. And last Thursday we did a cool giveaway which you can find in the description beneath, and you can still join that giveaway. If you like what we do, our trade letter and recently added premium membership can be tested for 1 week for free. The links in the description gives you all the information you need to join for free. In this update we'll be covering the topics that you'd like to know. The yields have been going mental and macroeconomics have been taking over heavily. First of all, the crazy market environment in Europe will be discussed, and after that we'll dive a bit into Credit Suisse and Deutsche Bank, and finally we'll jump into the outlook for the next week, which will bring us the CPI data, and ultimately that will bring us the information we need for the potential pivot of the Fed. In periods of macroeconomic downtrends, every asset is ultimately driven by one thing. It's the global liquidity, and in the image next to me you can see the direct correlation between Bitcoin and global liquidity. Essentially, this is slightly comparable to the strength of the dollar currency index DXY and Bitcoin as well, as those are moving in tandem inversely, but it indicates why Bitcoin hasn't been doing great the past year. Global liquidity consists of three phases: expansion, neutral or withdrawal. And currently we are in a period of withdrawal, also known as QT. The longer this phase lasts, the more evident the real weaknesses of the market will become. In the charts it looks like this. In crypto market we saw this for example with 3AC. If you trade a lot with leverage and collateral, this is not a problem as long as prices go up, but in a bear market where all prices go down, sooner or later margin calls will appear on the scene. In all likelihood, the large amount of collateral cannot be added and the company becomes a forced seller of the assets until bankruptcy. If we want to go back more in time, we know that in every expansion of the market, companies go bankrupt. I hope you still remember the real estate market crash in 2008. Well, it's often very easy for mainstream media to portray crypto in a bad light, which is often what happens until one finds out that traditional finance works in exactly the same way, and this brings us back to the news from last week's video about the yields. Countries such as Great Britain, Japan and Germany have problems around the liquidity of yields and especially the lack thereof. This caused abrupt rises which translated directly to pressure on the local currency. In the picture next to me, once again, the inverse correlation between the British pound and the 2-year and 10-year yields in Great Britain. That the situation was bad, we already knew that, but just like what I mentioned earlier with 3AC, the longer a downtrend continues, more and more weak links in the market operation emerge. In Great Britain, these are the pension funds. And now the question will be, how do pension funds actually work? A simple model. You know, you will need to pay out a bunch of money 30 years from now, so you buy some 30-year government bonds and hold them to maturity. When the bonds mature in 30 years, you have money, which you give to the pensioners and you're done. Obviously very simplified, but you get the idea, and it goes further, hedging current positions with borrowed money based on your collateral. The idea sounds good, but because of the hedge with borrowed money, you turn a stable pension fund into a volatile investment that can run into trouble with unexpected market movements. And this is what happened when 30-year long bonds went from 2.5% to 5% in the past week. Because of that sudden rise, the funds suddenly got margin calls and had to put in more collateral, and then the Bank of England stepped in because margin calls of such high amounts cannot be sustained by the pension fund themselves. Besides, In a world where we are so incredibly in debt, a pension fund cannot just fall over. Partly because of this, we had the Bank of England announcing unlimited and immediate purchase of long-dated bonds. A maneuver which should keep holders of long-dated government bonds, which we call gilts, from forced selling when interest rates go up. The next image explains it the best. See the difference between the negative feedback loop on the left and the stop of this feedback loop, but at the expense of the GDP. Central banks stepping in to protect the economy comes at the expense of fighting inflation. In addition, it is a long-term local currency destruction. Currently, we can divide central banks into three camps. The first one is those who sacrifice the local currency to protect the local bond market. That camp has been led by the Bank of Japan for a long time, but is now represented by the Bank of England and also with China. You generally want to short these currencies. The second one, those who partially sacrifice both the local bond market and the local FX market, with the ECB currently being the best example. And the final and third one, those who sacrifice the local bond market to shield the local currency from negative market moves. The best examples are the Fed, but also Mexico and Brazil. You generally want to long these currencies, and that's what has been happening in the past year. The next victim for this seems to be clearly Europe. And what's happening in Europe as well, a topic we have been addressing earlier this week, but we will cover it again. It is Credit Suisse and the Deutsche Bank. A different story, but the same problem. Credit Suisse and Deutsche Bank are on the verge of a collapse. We discussed and addressed that earlier this week. These two huge banks are also in trouble as risky investment strategies and thus too little collateral to turn the tide. The banks have a combined asset value of about 2 trillion, which is 3 times the asset value of Lehman Brothers, which we know from 2008 and went bankrupt and started the actual economic crisis back then. Insolvency of banks is itself a big problem, but these banks are both also labeled as too big to fail, just like the Lehman Brothers. If we look further, we see that both stocks are about 90% down from their all-time high, but that also the credit default swaps, which is essentially a financial derivative that allows an investor to swap or offset their credit risk with that of another investor, for Credit Suisse for example, are going absolutely vertical. The consequence may be obvious, but banks that have to pay their debts and thus additional collateral become insolvent and become a forced seller. This causes asset prices to fall, causing other banks to also become forced sellers of assets. This cycle continues until something changes in the form of central bank intervention. And this intervention may yet become a problem, since the Deutsche Bank alone has an asset value of 1.5 trillion. A huge value to take over for the central bank, and maybe even impossible to do so. So these kinds of problems arise in an economic downturn of such proportions. There is much more going on behind the scenes, but we will largely discuss that in the upcoming macroeconomic bootcamp for 8 global members, and maybe you can actually join. In this downturn, we look for signals showing that the economy is being completely destroyed. In fact, something will have to break down before policymakers realize that they have gone too far and will completely reverse the global liquidity policy, as they are thus doing that in Japan or Great Britain. For this, we look at economic data and with an outlook for next week. In the image next to me, you can see the schedule of next week's events. And we discuss this daily into our 8 Global Discord and respond to the expectations just like we have been doing in the previous week. For next week, however, we have one very clear headliner, which is CPI and core CPI. Not that this data is the most important in terms of policy, but in terms of market reaction. CPI is expected to fall sharply in the coming months, but the question is whether that will show up in the data this month already. Should I be right? All the macro doom posts of the past few weeks will seem very foolish. If CPI remains sticky for the time being, then the markets will not get any leeway from the Fed yet. It is essential to realize that CPI will determine the market direction on Thursday, but in addition the PPI and the FOMC meeting minutes are also important. The PPI measures inflation from the perspective of cost to industry or producers, and in the FOMC minutes, it reveals what was pre-discussed before the FOMC ruling, and we may be able to gauge the tone of policy. With this data, we can estimate the current economic situation, but especially think ahead about that approaching tipping points in the economy. Other data points that I personally still find relevant for our own data collection and prediction of the economic situation are the following: unemployment claims, retail sales, and consumer sentiment. And unemployment was given on last Friday. And as we know, in previous weeks, massive misses on economic data came out. ISM PMI came out lower than expected, but still positive above 50, while also job openings has been moving downwards substantially, and as a result, the markets have been giving a reaction with the yields falling and indices going up, implying that a pivot might be around the corner. That's why next week's CPI will be very important to watch. The macroeconomic world is incredibly complex and plays out over many different scales. I think you have noticed by now that I pay extra attention to this on my channel because I want you to understand it. So in this video, I took you through the impact of a downtrend like this one. Many weak links of the economy become visible, often harmless, but sometimes of such magnitude that central banks have to step in to protect the economy. Today, we discuss the impact of some events and the outlook for next week. Also, you've heard me talk about a macroeconomic bootcamp, more about that in the next few weeks. Thanks for watching. Make sure to hit that like button and also subscribe to YouTube. And don't forget, don't do stupid shit, stay calm and avoid emotional trading. Ciao.